trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Good afternoon, Market Rebels. Welcome back to Coach's Corner. And today we have Scott Thorstenson joining us again. Welcome, Scotty.
Good to be here.
All right. And of course, everybody knows Stu. Stu, what's going on?
Howdy, Skipper.
All right. Well, today we always want to come up with a topic that is going to be helpful for people and things that we find out are problem areas, usually from our coaches here, that say, you know, I get all these people asking this question. And should I use this strategy or should I exercise a call early? And so that's where we get a lot of these topics. These are very common problems or questions. And we just thought it'd be helpful to pass a lot of these things along to you for our viewers. So today, we're going to talk about one of those right now. And so here's our Chalk Talk question, which is a little thought-provoking question for you to think about, kind of maybe do a quick answer in the back of your head or jot it down. And then we're
write it down. Commit.
Yeah, write it down. Commit to an answer, and then we're going to come back at the end and answer it for you. So here's the question: you own a 1-year $100 call for $12, and then 8 months later the stock rises to, let's say, $120. The question is, should you exercise the call early? Now, this is just an example. It could be a 30-day option and 10 days goes by, or a $4 call. It's not really the issue. It's just a question of should you exercise it early. I'd like to hear from both of you if you've heard of reasons why people tend to do this. I wanted to share one that I have heard back when I was on Active Trader, and we would have, let's say, a stock like this, and people would call and they'd say, well, I want to exercise it early because I want to be able to be sure that I can pay 100. This stock is on fire. And what if it falls below 100 and I miss my opportunity to pay 100? You know, all my friends are I know it sounds comical, but all my friends are paying 120 and it keeps going up. That's on fire. I want to make sure I can use my coupon and pay 100. And that's what I have found why a lot of people feel this urgency to have to exercise it. Any other reasons that you've heard?
You got any, Scott? I got
understanding of what that call option is doing, because the call is gaining the value.
The call, exactly.
Stock, and oftentimes it's just a misunderstanding where folks believe there's a greater value to exercise. And exercise, you're right. It's not something that happens to you.
It is. That's
but
right.
You really, really never want to exercise early.
So we're actually gonna divide that into two parts, and so that's our question right there. So here is the topic. Probably
I have one.
let's
you
hear
want-
it. Sure.
So I hear this fairly, not often, but I hear it every now and then. I don't really want to pay the extrinsic value, so I'm just going to exercise and take the stock.
Because it's going to decay away.
Because the theta, I don't want to pay theta.
Right.
So I'm going to get rid of it.
Gotcha.
And I'm going to go ahead and exercise. What do you think of that, Stu? And, I can't even begin to answer that. So go ahead. Let's go.
All right. So that's our topic here. Should you exercise a call option early? So again, this comes up an awful lot. Now, for this presentation for today, we are assuming no dividends or a non-dividend paying stock. Now, when we say that, we have to be careful. That doesn't necessarily mean that the stock doesn't pay dividends. It means it doesn't pay dividends over the life of the option. So if you
the life of the option that we're talking about. So what Bill's saying here is for this expiration that we're talking about, for this option,
this would certainly
there's not going to be a dividend. It might be a dividend for next expiration or next month's expiration, but for this one, there is none.
And that's a good point. I take that back. There is a time where you may want to exercise early, but only if that dividend is larger than the value.
That's also a little tricky area. We hear a lot of people saying or misinterpreting that they should always exercise because of a dividend. So what we're going to do, we're going to divide
as well.
Which is untrue. What we're going to do is to divide this topic up into two parts. For this week, we're going to assume no dividends. So either A, the stock does not pay dividends at all, or maybe you've got a 30-day or 60-day option and there are no dividends being paid over this time frame. That's what we mean by no dividends. Next week, we're going to hit the same topic, but we're going to look if a dividend occurs over the life of the option.
Excellent. That's always a spirited discussion.
Exactly. So as Scotty said, but even then, we hear a lot of people misinterpret that they should always exercise because of a dividend, and that is absolutely not true. It might be. So
and for today, there's a little sidebar here. When we do that next week, everyone, keep in mind that when we're talking about should we exercise for the dividend, the same discussion goes for if you're short the call, can you expect to get a sign? It's the same discussion.
Good point. Very good point. Because a lot of times people say, should I expect to get assigned on this? Well, this is how you're going to figure it out.
Yeah.
And now if there are no dividends, what's the answer to that? No, you should not expect it. Does that mean it can't happen? No, it just means it was a gift and it was a mistake. And you'll find out why in a little bit. Yeah. So again, for this presentation, we're assuming no dividends. So let's start off with the answer first. This is like Jeopardy here. So the answer is, as Scotty already said, it is never optimal to exercise a call option early, keyword early, on a non-dividend paying stock. Again, non-dividend means no dividends over the life of the option. Now, a couple other points. This does not mean that you should never exercise a call. And it does not mean that that you have to hold the call all the way to expiration. As we're going to find out, if you want to get out, you would just close it. We're talking about exercising the call, paying the strike, and getting the stock.
This is under like everyday course of business kind of assumptions. I mean, there's always going to be something where you could say, well, I have to exercise to meet the tender, or, something.
The whole different, exactly. That's a good point. We're assuming that everything else is constant. It's just a question of whether you want to get the stock now or at expiration. All right. So now that we know the answer, that it is never optimal. Now, that's a strong word. But there's very good mathematical reasons that if there are no dividends paid, it is not going to be in your best interest, which means it's going to cause a financial loss if you exercise early. So let's find out what these...
Which is the strong word there? Optimal? Never?
Never.
Never. Okay.
Yep. I like the visual.
Epic fail.
Epic fail. Story of my life. Epic fail.
So here we go.
My first 2 marriages. Okay, sorry.
So let's take a look at the reasons in detail. All right, so we know the big picture. The answer is no. But if you want to drill down and say, well, why, which you always should, there are really 3 big reasons that exercising early on a non-dividend paying stock is going to cost you. You are going to lose three advantages. First one is you are going to lose interest earned on the exercise price. You're going to lose the extrinsic value. And probably the most important, you're going to lose the downside protection.
So let me make a short comment here. Number one and number two are absolutes.
Yep.
Number three is an absolute, but you may not care about it.
Yeah, good point.
Right, you may not care about it. Which begs the question
depending on where that stock is.
Yeah. Why did you get into the option in the first place? So it's kind of a circle here, but keep in mind that the first two, everyone, absolutely, no matter what.
Yeah,
it's
these
not
are
subject to discussion how you feel that day, whether you're, feeling good or not feeling good or what you think or about anything. It's going to happen.
It is going to happen. So the thing to understand is that exercising a call early creates no benefits for you, but it exposes you to risks. Now, you've heard us, I know we talk about in the industry, we usually call that a danger. So kind of an example, let's say if you have a $5 vertical spread trading for $4.95, why would you continue to hold it? There's really no upside, but there's potential downside. We usually classify that as a danger. And that's what this is.
Isn't that an upside?
It's maybe not a perfect danger, but it's awfully close. But in this case, there's absolutely no benefits. There's not even a small room for argument of saying, well, you could squeeze out an extra nickel. There's just nothing. It's only potential risks. So one thing to understand here at this point, remember, you can always exercise and pay the strike. Right. So why exercise
always.
Early?
What do you mean? What do you mean by always, Bill? Like for how long?
As long as the option's alive, if it hasn't expired, that you can always exercise and pay the strike. So back to my example, if the stock is 120 and you've got the $100 call and people are saying, well, I don't want to lose this opportunity. You're not. You could wait until tomorrow and pay 100. You could wait for 3 weeks and pay 100, and you could wait all the way until expiration.
So in the original example, if it was eight months into a year, anytime between 8 months and a year,
your cost is going to be 100.
You can exercise if you choose to. You have that choice in life.
And that stock could go from 100 to 120 to 900 or 1,000, and it doesn't matter. You can always exercise and pay 100. So relax. All right. So that's kind of the bigger picture, the simpler answer of why it's not going to benefit you. But we're going to drill down a little bit further and find out the details. And as always, before we do, for anybody who's new, please check us out at marketrebellion.com/get started. Lots of great articles, videos, tutorials, things to help you get started. Because as we talk about all the time, guys, there is a lot of bad information out there. I know we always kind of internally send emails to each other going, can you believe this? Or look at this document. We're going, unbelievable. It's out there. There's so much bad information. You want to make real sure you're getting the proper training because it's very easy to fall into traps, and early exercise is one of them. So let's take a look at an example.
It's not the true resource, Bill.
Do what?
The internet's not the true resource.
You know what? They actually have proven that there is bad information on the internet.
Is that what I've been doing wrong all my life? I've been just reading crap on the internet? Okay.
Exactly. So yes, there is very bad information. And what makes it even more dangerous is that a lot of these people aren't necessarily intentionally giving you bad information. They just don't know any better. They were trained from somebody who didn't know, and they just say, oh, that must be the way that it works. They open up their own YouTube channel, and they're just passing along more garbage.
We actually did a show on that. I think it was something about information cascade.
Oh, yeah.
It just keeps rolling and rolling and rolling. It
just keeps getting passed on.
It's all the same, not good information. Okay.
Yep. So let's take a look at an example. Stock is trading at 100. We have 365 days to expiration, also known as 1 year. Interest is 5%. Volatility is 20%. And if you put that into a pricing model, the $100 call is going to trade for $10.45. Right now, again, it doesn't matter which numbers you use. You're going to come to the same conclusions. We're just putting this up here so it's easier to follow. All right, so let's look at danger number one about losing interest. If you exercise, you are going to pay the $100 strike today for the shares. Well, Stu, where are you going to get that money from?
I got to go into my piggy bank and break it open.
You got to go into your money market, which means your broker's going to say, fine, you clicked on exercise. We're going to sweep it away from your money market and pay for the stock. All right. No harm done there.
Point A under number 2. You're gaining interest on the money in your money market. People, don't forget that.
That's right.
People often forget the idea that money is working at all times when it's in an interest-bearing
until you withdraw it.
Until you withdraw it, then it's not working anymore.
So now you're going to miss out on Now you're going to miss out on 500 beans.
500 beans, and that 500 beans came from the $100 stock, $100
times 100 shares,
$10,000,
5%.
Right, just simple interest.
$500. And once you do that, all right, congratulations, you are going to hold 100 shares. Now, this is what we sometimes call a missed opportunity. You're not really spending 500. You're not writing a check to pay the 500. It's just that you're missing out on it. It's called an implicit cost. So let's take a look at choice number 2. Let's say that you leave the...
I wish I had learned the difference between that when I was like 25.
Oh, yeah.
The ability to say, well, it's not really costing me anything, but then there's the opportunity cost on the other side.
It's so easy to overlook that.
It's all over the place. It's everywhere you look. It's and people just don't take that side of the equation into account.
Yeah. So let's look at choice. I don't know what happened by header here, but this is if you leave the $100, in other words, we don't exercise, you leave the $100 in the money market, and now you're going to earn $500 interest over that year. And instead of holding the shares, you're going to hold the $100 call. But what do we do at the end of the year now that we've got $500 in here? Now we exercise and we hold 100 shares. The guy on the left holds 100 shares, but we have $500 that this guy doesn't.
Yeah.
And yet both of us
kind of looks like the same outcome.
Same outcome, but one person is ahead by $500. Now there's a little math that we have to look at here. Thing called the present value of the interest. So anybody who's had finance will certainly knows what this means. But what that means is it's really today's value of something that is occurring in the future. So for instance, the future interest in this example right here is $5, right? Or per share, $100 times 5%. But we don't get that now. We get it in a year.
In a year. Just like if you bought a T-bill. It's in a year.
That's right. Yeah. Right. But that doesn't mean it's worth $5 today. So what we have to do to figure out what it's worth today, we would have to divide by, assuming it's a year away, we have to divide by 1 plus the interest rate. So the $5 future value divided by 1 plus the interest rate is $4.76. So what that's telling you is that if you deposit $4.76 into a bank that pays 5% interest, you will have $5 in 1 year.
Right.
So if somebody owes you $5 in a year, you should be willing to take $4.76 today to settle the debt. And a lot of people,
other way.
Yeah, it's just saying that's today's value. Why? Because you could deposit $4.76 and have 5 in a year. It's 2 different ways of coming out to the same outcome. So this is what's called the present value or today's value of the interest. And there's my header. I don't know what happened to the animations there. So that's if you don't exercise. So the key is by not exercising, you can still come up to the same outcome, but you're ahead by $500. Now, watch this. Let's go to a pricing model. Here's our $100 stock, $100 strike, 1 year to expiration, risk-free interest rate. And let's set the volatility to 0. All right.
Okay.
What's the model telling us? You got to pay at least $4.76.
Well, looks like the present value.
Present value of the exercise price. That is the bare bones minimum for any call option, assuming that we have a non-zero interest rate. You got to pay, it's got to trade for at least the present value of the stock minus the present value of the exercise. Otherwise it's arbitrage. It's free money. Yep, yeah. Free money. So this is kind of another way to show it's got to trade for at least $4.76. And if you exercise early, you're pitching that away. It's flushing it down the toilet. You're saying, I don't want it.
Where's it going? Who's getting it?
Seller.
Seller's getting it. Everybody remember that, right? So if you're the seller and you're short the option and you get assigned early, could be a nice gift. Right?
It's a
If there's
gift.
$4.76 or $1.22 or 62 cents or $10.82, whatever it is, and you get that now instead of having to go through the whole well, how much theta am I making today thing.
Right.
It's a gift.
It is a gift. Right. So that's the first thing. Everybody with us, you're going to throw away the interest. Now, problem number 2, you're going to lose the extrinsic value. Now, technically speaking, the extrinsic value includes this cost of carry. Usually from a professional traders, when we talk about the extrinsic value, we mean outside of cost of carry. What we mean is the volatility value. But yes, you are just pitching away the extrinsic value. So exercising the option, you lose the option's extrinsic value. Now you don't lose the intrinsic. And the reason for this is that you can either exercise or close, but you can't do both. You don't say, I want to exercise. Oh, and by the way, now I also want to sell to close and pick up the cash. It's one or the other.
Wait a minute. I think some light bulbs just went off here. What do you mean I can close? Let's say if I'm going to wind up with the stock, can't I just, I'm probably getting ahead of you here, right, Bill? I mean.
Yeah, we're going to talk about that. If you want out, you would just close it for this reason.
Just sell it.
Just close it. Yep.
Just sell it. Sell it and buy the stock. Oh, wait a minute. Isn't that a covered call? Oh.
We're going to talk about that. Very good. All right. Okay. So let's talk a little bit more about losing this extrinsic value. Let's say the stock rockets up to $120. Kind of looks like our chalk talk question here. And some time has gone by, maybe that there's 260 days to expiration. And the pricing model says that this $100 call is now $25.14. Well, the extrinsic value is how much? $5.14. All right. So for people who might be new, we have the right to pay $100 with this call, but the stock is at $120. So there's like this immediate benefit of $20.
All right. So that $20 is the intrinsic value.
That's the intrinsic value.
$20, and anything over that is
$5.14. Sometimes we call this the meltdown value. If I exercised this call and I sold the stock, I could put $20 in my pocket. But anything over and above that is from volatility and cost of carry. Yeah. So the exercise, if I exercised it, I would pay $100. I'm going to be holding stock worth $120. I would have a $20 unrealized gain, which could be lost. It's not sitting in a money market. It's sitting in the stock. But if I close the call...
And the value of the stock going down.
Exactly. But if I close the call, I'm going to get $25.14.
Take it.
And notice that $25.14 is greater than 20, and that will always be true if we have something above 0 for an interest rate. You're going to be better off. Now, this is assuming that we want out. We think the stock is going to come unhinged, or we've met our goal, whatever. Don't exercise it. Don't exercise it and sell the stock. That would net you $20. Close the call.
Yeah, so might as well take in the 514.
Might as well. So again, to be clear, this is we hear this all the time where people say, "Oh, I want to get out, so I need to exercise, or let me exercise and sell the stock."
Or if you want to make a donation, you can exercise.
You can exercise it, or they'll say that this means that
donation to those scumbag market makers.
or they'll say that this means I can't get out until expiration. That's another misinterpretation. No, we're not saying that at all. We're saying if you want to exercise, wait until expiration. But if you want out, sell the call. And this is why. Now, let's say what would happen if you sold to close. All right, you're going to collect $25.14. This is another way to show why it's not optimal. I could close that call, put $25.14 in my pocket, but if I wanted the shares, I would have to pay $120. I've lost my right to pay $100. But what's my cost between these two? $94.86. So if I pay $94.86 effectively, and the stock is $120, I've got an unrealized gain of $25.14. And notice that this guy has an unrealized gain of 20. I'm better off by $5.14.
In other words, you just collected your extrinsic value.
Yeah. So take a look at that. Yeah. Would you rather have an unrealized gain of $25.14 or of 20? So many different, doesn't really matter how you slice and dice this, that you're not going to be better off by exercising early. If for some reason, and I can't think of what it would be, but if for some reason you wanted the shares now, then sell the call and buy the share. Give up your right to pay 100.
Well,
but at least
I could think of one or two, and let me just throw them out there, because you're too lazy to figure out how the product works, and it's much easier to navigate with a stock that can, be bought and sold very easily with just, the platform. The option is not complicated. It's not hard to understand, but it does take a little work. And if you take the time, you can gain a lot of advantage in the risk advantage world. But that's not really, that's not mathematics. It's just
that's right. That's just not understanding the product.
Yeah.
Okay, so that's the first thing. I want to make sure that everybody understands that. All right. So if you want out, that's okay. Nobody says you have to hold it to expiration. But if you want out, close the call.
Close the call.
If for some reason that you want the stock, sell the call and buy the stock. But people go, oh no, I want to pay 100 for it. I want to use my strike. No, grab the extra 5 or 514 here. You're going to be better off.
So, Bill, these are contracts,
there's
right?
Something mentally that makes you feel like there's value, like you have this
and
right
using
to
the $100. I know.
But I've never exercised. Stuart, I can't. Have you ever exercised the call option?
Not if I didn't have a good reason to. No.
Yeah.
But I don't know what it is. Sometimes there's that implicit assumption there's some value in doing that, but no, it's always better to just close your option. Just sell it. Sell the call option.
They say, oh, I've got the right to pay 100 when it's trading for 120. That's what I talked about in the beginning. They feel like that's the benefit. And they have no concept of extrinsic value.
There's no value in exercising your right.
The exercise is a process.
Right.
It's just a mechanical way of getting the shares.
Exactly.
So, kind of think about, well, I'm going to get the shares. I want the shares. Is there another way I can get the shares? Yeah. Buy them.
Yeah. Sell the call, close, buy the shares, but
just trade it in. Go to the used car store and trade it in for the new car, which is your shares.
Yep. But again, people can't get their mind around it. But now I got to pay 120 for it instead of 100. That can't possibly be good. But $20 is intrinsic value. It's got nothing to do with the option.
Bill, is there something in the bullet points of the terms of the contract that says you can't sell it before expiration?
No.
Scotty, have you ever seen any of that anywhere?
No, you have the right. You have the right, but not the obligation.
As long as the options market is open, you can sell it at any time. It's got nothing to do with the date. Sell it. You want to sell it? Sell it. Put it in the queue and bang, hit the send button. You're done.
Yep. All right. So now let's
sell it early. It's a wool sweater. You're itching to get it off, right? You always want to sell that option.
Right. All right. Let's take a look at problem number 3, that you're going to lose the downside protection. And this one is probably the biggest one to be concerned with, because
unless you don't care, right?
Well, possibly, but we're going to find out that an option is ultimately an insurance policy.
You should care.
And what you're doing is you are giving up that insurance policy and you're not getting compensated for it. So for example, let's use our stock at 120. So if you exercise, the most you can lose is 120, theoretically, right?
Because you're going to own the stock, and theoretically,
the stock is currently at 120. All right. Now, your $100 call is trading for 25.14. And now the most you can lose is 25.14.
What's that bike that was like $130? It's like $3 now. Peloton.
Right?
That's kind of this one, right?
A great example. During COVID, everybody thought it was going to be the next Berkshire Hathaway, right?
Yeah. Look, there's a ton of stocks. And nobody here is saying that, like, every stock out there is going to go to zero. But we have to look at the big picture and say, well, where can it go? This is an effort to be a risk manager and quantify potential losses. Right.
And even if you want to say, okay, I think that's completely impossible for it to go to zero. Can you see it falling more than $25.14? Well, that shouldn't be real hard to visualize. And yet this is the maximum in this position.
Yeah.
So remember that a call option is stock plus put. Here is your insurance policy.
Right there.
And what you're doing when you exercise early,
Getting the stock.
You're getting the stock. Here you go. There's your stock, but you're not getting the corresponding put. So what you're really doing is you're saying, hey, I want out of my insurance policy, but you know what? You guys keep the money.
There you go. Nice job.
Not a good. So an example I use, and you guys probably use it in coaching as well, but we've talked about it in Q&A. Think about if you go to, let's say, Geico, and you buy a 1-year policy from Geico, and 1 month later, you say, you know what? I don't want this insurance policy. I want out. But you know what? Instead of crediting back the other 11 months, you guys just keep them.
Well,
that's what you're doing.
Mr. Johnson, we're going to prorate that amount of money, and we're going to send you a check. And
no. You know, just keep it. But I just want out of the contract. You go, what? Why would you do it? That's what you're doing when you're exercising early.
Yeah.
You're saying, I don't want this insurance value anymore. So let's take a look at it graphically. Here's the numbers from the previous slide. Here's the stock at 120. So in black is the stock. If you exercised, you would be owning shares at 120, right? And you're on a straight line, delta 1. But if we look at the red line, this is what's called the current curve. This is run from a pricing model. And down here, this maximum loss is 25.14. So you can see that with the stock up here, all right, not a real big difference between the red and the black line, let's say in a short area, or at least certainly from here forward, but even not real big down here. But what if it falls down here to 105 or even 110? Now we're seeing a little bit of a gap. 105, we're seeing a bigger gap. Look at the size of this gap. It only gets bigger and bigger. In other words, we're becoming more and more insured as that stock falls. That red line is heading left, whereas the black line is heading south or southwest. So you can see that if for some reason the stock becomes unhinged, you're going to wish that you had never exercised it early, because otherwise you're taking the ride down on this black line. So that's another reason to show, even if you could get it for parity or anything else, why would you want to let go of that early? You might as well hold it all the way to expiration or close it. But there's no reason to put yourself from the red line to the black line and pay to do it, which is another mathematically what you're doing. You are paying money, or you're losing some, but you're effectively paying money to shift from the safer red line to the more dangerous black line.
You bought the call because you want the call instead of the stock in the first place.
Exactly.
You don't want to buy the stock.
You want the red line. The red line has a benefit, and yes, you have to pay for that. The benefit is that you have an embedded insurance policy. And so what you're doing is letting go of that. All right, so that's a good visual for problem number 3. Now we're going to look at some other angles of this. And before we do, quick reminder, please check us out, marketrebellion.com/get started for more great materials like this to help you get started with options. So problem number 3, alternate view. If you exercise, we usually call it you exercise your option and just kind of wave goodbye to the call. Mathematically, we could think of that as selling the call. It's kind of a good little mental exercise to say, well, what if I sold the call and bought the shares? Isn't that effectively what I'm doing? I'm getting rid of the call and I'm ending up being long the shares.
Absolutely. Yeah, you're going to get the shares and you don't have the call. To me, that's selling the call and buying the shares.
Right. And if for many of you who have Thinkorswim know that if you've ever clicked on exercise, if you don't, try it in paper money, it'll bring up an order down at the bottom and it will default to sell the call, buy the stock for the strike. Mathematically, that's what you're doing. Now take a look at this. If you buy shares and sell a call, what is that, guys?
Looks like a covered call to me, a buy rate.
Covered call, which is the same thing as a naked put.
Absolutely.
So if we go back to our synthetics, and if that doesn't make sense to you, we have another coach's corner on this, but a long stock position plus a short call equals
your covered call.
Short put.
There you go.
So this is going to give us...
Ask yourselves, do I really want to sell the put?
Do I want to sell a put now?
The answer may be yes. Look at the price. Maybe you could sell the put for money that you wouldn't ordinarily get, that you wouldn't get if you just exercise the calls? Maybe kind of a double whammy, right? Maybe you're going to be
hold that thought, but you're kind of reading my mind here. That's exactly what I wanted to show, and this is a little a teaser for next week. This is what we're going to rely on to see as an alternate method if it makes sense to exercise for a dividend. But what I wanted to show here, take a look at this. Here's the original long call, let's say the 100 strike. Right, here's our expiration graph, relatively safe because it's in green. And if we do the short put right there in red, all right, we've got this unlimited downside, but we have limited upside. But if we buy the call in green and we sell the put in red,
yep,
what happens? These two lines combined give us that.
Which is what your stock is, people. There you go.
And there's your stock. That's what you were going to do anyway. If you're going to exercise the call, you might be a whole lot better off. And in fact, I'd say probably 95% of the cases you will be, even with a dividend, to just sell that put if you want to put yourself on a straight line.
Well, yeah, to see what the price of the...
Well, that's what I'm saying. In most cases, right, because it's going to get accounted for, but there's usually a risk premium on the puts.
Yeah, and so... It could be, right? And that's why when we do the whole dividend swap thing, which that's the calculation next week. That's the deciding factor. Really.
That's the deciding factor. But what I wanted to point out is that's why you can't say just because a dividend is coming up, it's an automatic exercise. No way. Nope. And a lot of people say that. So don't confuse the issues. Okay, so with this, exercising calls on non-dividend stocks. Remember, that means that it's not paid over the life of the option. You can always exercise and pay the strike. So ask yourself, why pay early? What's the benefit?
Because you don't feel like dealing with it, I guess. I don't know.
Well, then close it.
Yeah, close it.
Yeah, close it. There's no advantages to exercising early, but there are many downsides. So there's three that we covered. So if you want to exercise a call, certainly okay to do. Wait until expiration to do it and make your decision then.
You'll have
you'll have more information. Right. Yeah. If it's Enron and it's in the middle of a huge dust storm and you're going, man, I'm glad I didn't exercise it, then you're going to realize another benefit why you didn't let go of that insurance policy. Get as much information as you can before you pull that trigger and exercise. Wait until expiration. Yeah. But if you do want out, then just sell the call. Just sell it to close, but do not exercise. Okay, so with that, we hope that gives you the answer. I think we've kind of covered it, but what do y'all think? You own this call, stock is running like the wind. Should you exercise early to get the stock?
Never.
No, not going to happen. Boo. Epic fail.
Epic fail.
Epic fail. That is right. So we see that a lot. We hear it a lot. It comes up in our Q&A, and I know you guys get it all the time for coaching sessions, and we just wanted to pass it on to our market rebels out there in YouTube land. So how did y'all do? I hope that everybody out there, if you thought that, yes, it would make sense, we hope you now see why it absolutely doesn't.
Look, the bottom line is there has to be in order to want to do that.
Correct.
There has to be an economic benefit.
Got to be some money behind it.
And Bill has clearly showed here that there is not an economic benefit. Unless there's an economic benefit, which we may.
And where is that economic benefit going to be?
Well,
dividend
might come from the dividend.
Might come from the dividend, and now that changes things, and that's going to change our calculations. So how's it going to change? Well, for that you'll have to join us next week. We hope this at least got you started. Could at least keep you safe for another week in case you were thinking of exercising any of those NVIDIA calls. Scotty, any closing comments?
No, I think that was well covered. I would stress it never makes sense to exercise. Always just sell the option. I think sometimes it comes into play when in my experience with some new people, they just don't quite understand extrinsic and intrinsic value yet. They're still kind of in that learning process. So if you feel like it's not clicking, just dig into some education, get with us, and we can just help build that understanding. And I think it will make more sense for you.
Yeah. I always say there's a lot of misperceptions with options. And it's, as you mentioned, it's because they don't understand the extrinsic value. Or as Stu said, they might say, oh, well, I don't want to lose the extrinsic value, which is going to bleed away between now and expiration. The stock is guaranteed to go up. It's running like the wind. Let me exercise it. Well, no, if you exercise it, you just threw away the extrinsic value.
You just threw away. And
you just threw it away. You did exactly the opposite.
And now you gotta pay to own the stock.
You got to pay. You've got a cost to carry, and you've got unlimited downside now. It's a triple. It's a triple whammy, is what it is.
Maybe paid an exercise fee or used to pay
and some charge exactly back when they used to have some brokers still might do it just because it's an exercise. But even back when they had nominal commissions for stocks, they would still usually charge you a stock commission, sometimes a flat $15 or something, which is 15 cents in options terms. That also adds to the cost.
And maybe there's an allocation issue. It's not, I think most people don't have unlimited funds in their account. You're going to have to use more money when you own the when you own the stock than if you own the option.
Yep.
And now you don't have that money available for something else. I mean, it's like, a big
whole nother issue. Yeah. You're not as cost efficient. Right. So, anyway, we hope that gives you some things to think about. If not, if you're serious about getting into, advanced levels of trading and making decisions like this, please give us a call. Check us out at marketrebellion.com. You can even hook up for some coaching sessions with one of our world-class coaches here, with Stu and Scotty. And maybe join us for some of our Q&A sessions. We'd love to have you. And with that, that's going to cover it for today. And we hope to see you next Thursday, 4 p.m. Eastern on Coach's Corner. We'll see you then.
Yep. See you. Adios.
Have a wonderful weekend.